Welcome to ibbusinessandmanagement.com. I'm Mr. Burton, and today we're looking at 3.2 Investment Appraisal. 3.2 Investment Appraisal, the second installment in our accounts and finance section of the course. Okay, now investment appraisal is all about looking at the best investment for your business with the available finance that you've got. So your business is essentially looking at purchasing 1, 2, 3 or more assets, or making a decision between the purchase of different assets. So if we have a look here, comparing investments, we've got asset A, asset B. Now both of these assets are going to cost different amounts of money, so the business is going to have to front up with different amounts of capital for each of these investments, and each of these investments is likely to generate different cash flows for the business.
Show me.
So for example here, investment A and investment B, now they're both computer systems. Investment A, 2.6 million, investment B, 3.9 million. Across 5 years, they've got different annual net cash flows per year. So we can see in year one, investment A returns. Remember, this is running costs have been factored in. So this is the income that these assets are actually generating for the business minus the cost of running them. So year one, asset A is generating $510,000 in net cash flow. Investment B, the same amount. Year two, $650,000 for asset A, $700,000 for asset B, and right down. It looks like the assets are going to last 5 years, have a useful life expectancy of 5 years. You can see that investment A, asset A, it costs less initially to purchase than asset B, but you can see that asset B produces significantly higher annual net cash flows. So lower cost for asset A, lower annual net cash flows, higher cost for investment B, and higher annual net cash flows. Now there are definitely quite a few things that we need to consider as a business when making decisions as to whether to purchase a particular asset. And initially, the two big things that we need to consider: the cost to purchase and what sort of returns are those assets going to generate for the business. Remember, this is all about investment appraisal. How good is the purchase of this particular asset for our business? Cost is a big one, and not just the purchase cost, but then we're going to have annual operating costs on top of that. Additional staff hiring and training. Some assets we're going to need to get in new staff to run these particular pieces of machinery, pieces of equipment. Driving our vans, driving our delivery trucks. How long are our assets going to last? What's the useful life expectancy going to be for the business? Will we be able to resell these assets at the end of the useful life? Importantly, what are the expected net cash flows? What's the return to us from these assets? And we're going to measure that in expected net cash flows.
Show me.
Right, a good little introductory video here.
ROI helps investors evaluate the performance of an investment and compare it to the performance of their other investments. School is out for summer, and Joe's children ask for some startup cash for their respective summer businesses. Joe gives each child $100. In return, they must split their profits 50-50 with Joe at the end of the summer. Joe's daughter opens a lemonade stand. Joe's son buys a lawnmower. As the summer progresses, the children work hard at their businesses. Joe's daughter sells many cups of lemonade, and his son mows every lawn in the neighborhood. At the end of the summer, Joe's son has earned $500. Joe receives $250. Subtracting his original investment of $100, Joe is left with $150 profit, an impressive 150% return on investment. Joe's daughter has earned $1,000. Joe receives $500, minus the $100 original investment, and that's $400 profit, a whopping 400% ROI. Joe earned $4 for every $1 he invested. Joe's daughter provided the best ROI. ROI is one of many measures that help investors evaluate investments.
Okay, so nice little take on just one of the ways that we can have a look at returns on investment. Now, defining investment, we define that as the purchase of an asset that will hopefully, they don't always, hopefully generate future financial benefits. And that's capital that's being risked in a venture that might bring future advantage. Now, we're going to run through a few different investment appraisal techniques here. And we're going to use the stupid example, sorry, I apologize for this, but we're looking at a chain of hair salons, and they are deciding whether to invest a considerable sum of money to upgrade some equipment in their stores so they can produce the latest hair craze. Definition for investment appraisal. It is quantitative. It's a quantitative technique to calculate the financial costs and benefits. So we're comparing figures, we're crunching the numbers. Does this investment decision make financial sense? Would another investment decision make better financial sense? Okay, the first type of investment appraisal technique we're looking at is called payback period. Now, the payback period, this is a period of time needed for an investment project to earn enough profits to pay back the initial cost of the initial investment. So how long is it going to take for us to be able to recoup our initial investment? So we're looking at a time period here. How many years, how many months until our investment pays back enough money to cover the cost of purchasing that initial asset? So here we are, we have got our hair salon, hairstyles, a classy joint. Anything with a Z in its name is super classy. We know that. Marketing. Okay, hairstyles are going to pay $1 million to equip their stores with new styling equipment. We can see the new styling equipment down in that picture in the bottom right hand corner. I have no idea what it is. I'm a man. Is it hair drying things? Okay, so they're going to pay $1 million to be able to dry their customers' hair with this new styling equipment. Now, they expect this new equipment to generate additional cash flows over the first 4 years of the following amounts. Okay, year one, the hairstyling equipment is going to bring in net cash flows of 210. So this is cash flow with the operating costs taken out. Right. So net cash flows. Year 1, 210k. Year 2, 350. Year 3, 480. And in year 4 is bringing in $350,000 in the net cash. Our first step is to work out what we call the cumulative cash flow. So you're going to have to put another table there. Sorry, not another table, another column in your table and calculate the total running cash flows. So we can see here that in year 1 we've got 210,000. Year 2, 350. 210 plus 350 will give us total cumulative cash flows, year 1 plus year 2, of 560. Year 3, if we add another 480k onto that 560, we end up with 1,040,000. And total cumulative cash flows across those 4 years is almost $1.5 million. So, step 1, work out the cumulative cash flow. You'll need to throw down another column beside your net cash flows and calculate this. Okay, now we do know that the payback period is going to take more than 2 years. We fronted up with $1 million, and we can see that it's not until year 3 that we get enough net cash to pay back that initial $1 million investment. So it's more than 2 years, but it's less than 3 years. After year 2, we need another $440,000. 560 plus 440 will give us our initial investment of $1 million. Now what we're going to do, we're going to work out an average monthly cash flow for that third year. All we're going to do, take the year 3 cash flow and divide it by 12. So that divided by 12, that's the number of months in the year. 480 divided by 12 gives us 40, so that's 40,000 per month on average net cash flows. We need another 440,000 divided by 40,000 will give us the number of months to reach 440,000. Okay, so 440 divided by 40 is going to give us the number of months. Right. We can see that the payback period here is almost 3 years. It's 2 years and 11 months. Now, never ever in the history of IB exams has a student had to calculate a payback period where the months have worked out perfectly. Typically, you'll do your sums and you'll get a figure coming out the end, something like 4.73. And all we're going to do is round up. We're always going to round up. So 4.73 will turn into 4 years, not 7 months. We're going to round it up. 7.3, 8 months. Always round your figure up. Okay, we need to look at advantages and disadvantages of using the payback period as a method of investment appraisal. We'll start with advantages.
Show me.
It's the simplest and the quickest method of investment appraisal. Full stop. Nice and easy to calculate.
Show me.
It's really useful for firms that do not have significant cash flow. Where cash flow is dead important to certain firms. Now these firms are going to be able to tell how long it's going to take for their hard-earned cash to be able to be recovered. How long the cash they've fronted up with, how long is it going to take to be repaid? It's important for these firms.
Show me.
We'll, using the payback period, we'll be able to see whether or not the firm is actually going to be able to earn enough in net cash flows to be able to purchase the asset before it needs to be replaced. So if the useful life of the asset is 8 years and the payback period looks like it's going to take 10.5 years to pay back, then it's very unlikely that the business is going to go ahead and purchase the asset.
Show me.
Now we can take different investment projects, so project A, project B, and we can compare them, and we can work out the payback period for each investment type, and then perhaps we will decide on that investment which has the shortest payback period.
Show me.
Right, and it's good that it assesses only the short term. Because we're only dealing with the short term, payback calculations are going to be less prone to forecasting errors. If we're only looking 3, 4, 5 years into the future, then there are less chances of us making significant mistakes in our ability to forecast net cash flows. Disadvantages. Now remember, these advantages and disadvantages are very important if you are asked to evaluate an investment using this method. So first disadvantage, it is going to encourage a short-term approach to investment. Now some of our investment projects should be very long-term. If we are looking at purchasing a building, building a factory, we're looking at 20, 30 years into the future. But payback period focuses on the short term, and so just using this method to evaluate our investments, appraise our investments, we may be ignoring the potential gains that come with long-term investment decisions.
Show me.
Now the contribution per month, remember when we go into that final year and we divide by the number of months to find the average monthly cash flow? Well, the contribution per month is unlikely to be constant. So those average monthly cash flows, we're going to get lots of seasonal variation in our sales. So lots of December net cash flows are going to be much higher than our cash flows in the middle of August.
Show me.
Right. With the payback period, the focus is on time rather than profit. So we're just focusing on how fast can we pay back this money. So time rather than profits. And profits is really the main aim of most firms. Our second method of investment appraisal is called the accounting rate of return. Now this calculates the average profit of an investment project as a percentage of the amount invested. And what it does is it allows managers to compare rates of return on a number of investment projects. So we're looking at return on our investment, and we're looking at it as a percentage. If we front up with $1 million to purchase some sort of capital equipment, what percentage return in profit is this investment going to generate for the firm? We've got this formula here: total profit during the project's lifespan divided by the number of years of the project, and then we divide that by the initial amount invested. And because we're talking about a percentage, of course we multiply it all by 100. Now this formula is given to you in the exam, so you're not going to have to sit down, memorize it and regurgitate it come your IB exam, business and management exam. It's given to you. The number, the percentage that comes out, is often compared to a base interest rate. So for example, if you can earn 3.5% interest on cash that you've got in the bank, then we want to make sure that our investment returns significantly more than playing it safe and putting our money in the bank. Right, we're going to run through an ARR, show you how it's done. Quite an easy one to get your head around. Right, we're talking about the same salon, we're talking about the same sort of hairstyling equipment. This time we're just talking about a different capital amount. So we've shifted from 1 million that we used to purchase these in the payback period. We're just using 400,000 now. So the new hairstyling equipment costs 400 grand. It's forecasting to generate the following net cash flows over the next 5 years. They're only going to last the business for 5 years. They'll need to be replaced after that. They'll look a bit shabby. They'll look a bit they'll look a bit worse for wear, and after 5 years they're not going to be doing the business any favours, so they'll look at replacing them after 5 years. Year 1 they bring in 100,000. These are net cash flows again. Year 2 200, year 3 180, year 4 120 grand, and year 5 the net cash flows there are $100,000. A few steps here. You'll need to be able to memorize these steps. Nobody's going to give them to you. You'll have to practice and practice and get them sorted. So all we're going to do, step 1, total the net cash flow info, total the net cash inflow over the entire project. So all we're going to do, year 1 cash flows through to year 5 cash flows, add them all up, and if your maths is as good as mine, they come to $700,000. The second step in calculating our accounting rate of return is the project profit. Now, net cash flows, the revenues coming in, the income coming in is $700,000, but remember, it costs us $400,000 to purchase the things in the first place. So projected profit, $700,000 minus $400,000. Our projected profit is $300,000. So cash inflow minus the expense of the initial investment is step 2, calculating the project profit. Our third step in this process is average annual profit. So if the project profit's $300,000 and that's running over 5 years, $300,000, we're going to divide that by 5, and $60,000 is the average annual profit. So $60,000 on average per year is what this investment is returning. All we need to do now is find that as a percentage. So our accounting rate of return, average annual profit divided by the initial investment, it's a percentage, so we times it by 100. Average annual profit, we've got that, 60,000. Initial costs, 400,000, that's what we're dividing it by. 60 grand divided by 400 grand, times it by 100, and we've got a 15% average rate of return. That looks pretty good. If we can get 5% in these low interest times of ours, that 15% starts to look very, very, very good. If we can only get 5% return on the cash that we're accumulating as a business in the bank, we are definitely going to be looking at better ways to invest that money. Make a better return, make more profit for the business, which is what it's mostly all about. Now, a very important principle when it comes to investment appraisal is looking at the time value of money. Now, just think to yourself simply, if someone gave you $100,000 in your hand now, would you be willing to postpone that $100,000 got right now for receiving it 5 years in the future? Which is worth more to you, the $100,000 now, given to you now, or $100,000 given to you 5 years down the track? Money you've got now is worth more to you than money that you receive in the future. And it's the same with the business as well. The concept is called discounted cash flow, or the time value of money. Let's have a look now.
Show me.
The time value of money is a concept that states a dollar today is always worth more than $1 tomorrow. Suppose Steve wins $1 million in the lottery today. Before accepting his prize, Steve has to make a decision. He can receive the prize money now, or if he wants, he can collect the money in 1 year. Steve considers his options. If the money is taken today, he can deposit it in an interest-bearing savings account at the local bank that offers 5% interest per year. If he decides not to take the money today, he has to wait a full year with no money and no interest. Steve's not crazy, so he decides to take the $1 million sooner rather than later. When the money is withdrawn after a year, it has grown to $1,050,000. By taking the money early, Steve earned an extra $50,000. This is the time value of money as it applies to interest. $1 million is worth more today because of the possible interest that it earns over the 1 year's time.
Okay, so an important concept to know, and it's only higher level. It's only higher level. If you're a standard level student, you can fast forward. Right, discounted cash flow. So this is basically the question that we're trying to answer here. Why is money today worth more than the same amount of money sometime into the future? We saw in the video that we can take money that we receive today, put it in the bank, earn some interest, and that money over time is going to grow and grow. And the other side of that is inflation. So there are two reasons: interest earned on the money that we have got today, and inflation is going to do the opposite. Inflation is going to erode the purchasing power of money over time. So perhaps today, 100,000 can purchase us 3 delivery vans, but in 5 year time, we might need a significant amount more than that. Inflation, as prices are going to be rising over time. So what's it all about? Our investment is going to have a predicted cash flow. Now this cash flow occurs over a number of years. The cash flow in future years, the net cash flow in future years, is going to be worth less to us than the cash flow, than the same money if we received it straight away today. So if we have a look at the predicted cash flow in year 4, 100,000, that $100,000 is going to be received in 4 years' time. If we're looking at it in today's dollars, we need to be able to make some sort of discount on that future income stream. So we're going to use a discounted cash flow of 5%. Perhaps interest rates in the economy are 5%. So that's money we can invest in a bank, receive 5% on. We've got a formula here. All we do, 1 over 1 point the interest rate or the discounted cash flow to the power of whichever year we're looking at. We never discount in year 0 or the first year in investment. No need to. Time value. We're discounting into the future. So we can see here the formula becomes a lot clearer. So we've got that discounted cash flow. The exam will tell you which amount you'll need to discount by, and all we can see, we're raising that figure by whichever year we're looking at. Quite easy. And we make it even easier by providing you with the present value table in the examinations. So let's have a look. This time our annual net cash flows, they look like they're $250,000 per year for 5 years. If we use a discount factor of 3%, all we're doing is taking $250,000, going across to year 1. We see that we need to multiply our $250,000 by 0.9709. Year 2, Same discount factor, 3%, but this time we have to go to the year 2 figure and multiply our 250 grand by 0.9426, and so on and so on and so on for years 3 and 4 and 5. And there we have. We have discounted our cash flows using a discounted cash flow of discount rate of 3%. Now, importantly here, a common question: what's the relationship between the discount factor used and the future value of cash flows? The higher the factor, the lower the value of your future cash flows. The higher the discount rate, the lower the value of your net cash flows in the future. So if you're only using 1% as your discount rate, your net cash flows are not going to be discounted that much. But if you're using something like 16%, then your future net cash flows are going to be quite significantly reduced.
The net present value is the value of a specific stream of future cash flows presented in today's dollars. A project like a new factory or an extra drilling rig typically needs cash now in order to receive more money in the future. The net present value can be calculated by comparing the initial cost of a project to the total value of future revenue that project creates. Net present values are used to determine whether a project is worth doing. Dan, the owner of Dan's Pizza Shop, is considering purchasing a new pizza oven. Dan's profit per pizza is $5. The oven will allow him to make and deliver 1,000 more pizzas per year. However, the oven costs $20,000 and will only last for 6 years. To evaluate the purchase of the oven, Dan calculates the net present value of the project. The oven costs $20,000 in the current year. The incoming cash flows created by the new oven are calculated on a yearly basis. The oven will add $5,000. That's $5 times 1,000 pizzas in revenue to Dan's business every year for 6 years. But just because the new oven will make $30,000 for Dan over the next 6 years doesn't mean that's how much it's worth today. A discount rate is applied to this revenue so that a comparison can be made against an alternative investment, like a $20,000 bond that could be bought instead of an oven. The discount rates used are specific to each business. Although applying the discount rate will make the project look much less profitable than simply calculating how much profit it will generate over 5 years, projects with positive net present values should be carried out, while projects with negative net present value should be rejected. Net present value is one of many metrics that companies use to decide where they should spend their money.
And net present value, that's just one step further than discount using a discount factor. All we're doing is adding up our net cash flows across the years that we're looking at, and summing them. So establishing the future earnings, cash flow in today's dollars to make an investment decision, just like the video said.
Show me.
So we've got the sum of present values, and we're going to minus the cost of investment, or sometimes called the principal. Here we are, same amounts, 250,000 net cash flows being returned by this investment across 5 years. All we're going to do is discount them. We know how to do that. Net present value, we sum them. The sum of our discounted cash flows across those 5 years total to just over 1.1 million. The cost of our investment, $1 million. Our net present value, therefore, must be $144,925. The higher the discount factor, the lower our NPV. Okay. Our 3 quantitative investment appraisal techniques done and dusted. Payback period, accounting rate of return, net present value, tick tick tick. Easy enough to do, easy enough to calculate, easy enough to understand. But it's also important that qualitative investment appraisal gets some weight in your answers. So it's going to be important for managers to consider other non-financial being qualitative, factors when considering an investment. And there are a few of these qualitative investment appraisal factors that we need to consider. Okay, predictions, or sometimes called gut feelings, referred to as gut feelings. Now, investment decisions are often based on the intuition of changes in the future, predictions of changes in interest rates and income levels. The more experienced the manager, the more experienced the entrepreneur, the better these gut feelings are likely to be. Different objectives. Now, a profit-seeking firm, for example, is going to prefer to use quantitative methods, but perhaps a firm with a strong ethical stance may not give financial data such a high priority. Risk profile of the firm. Now, firms with a low risk profile, they don't like taking risks, are less likely to opt for high risk, high return investments, choosing instead to opt for lower risk projects with more certain returns. Now, this approach will protect the business if risk does not pay off, but it's going to limit their returns as well. The state of the economy is important. If consumer and producer confidence levels are high, for example, then risk projects might be undertaken. However, if interest rates are forecast to rise over the medium to long term, then managers may put off many investment plans. And we had a look at that. With our time value of money, our discount factors used. Higher the interest rates, higher the discount factor needed, the lower the returns on our investment as assessed using our NPV. What have we got? Corporate image. Managers need to consider how an investment project might affect its public relations and corporate image. For example, will the attention and response of pressure groups such as Greenpeace be an issue if the investment project goes ahead? Human relations, always critical. If you want to bring a qualitative investment appraisal component into your answer, and you probably do in any sort of evaluate type question, human relations is perfect. So what's the impact on your staff? So for example, is automation going to cause mass redundancies? If you go ahead and purchase that new machinery, that new automated system of production, how many staff are you going to have to make redundant? How will that change affect staff morale levels as well as the corporate image? Exogenous shocks as well, things like hurricanes, natural disasters of unquantifiable risk may also have to be considered when making investment decisions. No investment can be perfectly planned for, have some perfect risk number assigned to it. Okay, 3 questions for you to complete this topic, this 3.2 investment appraisal component in accounts and finance. I'm Mr. Burton. It's been a pleasure, an absolute pleasure to have you with me today running through this. I hope you're watching this whilst it's embedded in ibbusinessandmanagement.com, your best place to learn anything and everything about the IB Business and Management course. Thanks for joining me. We'll see you in time for 3.3. And if my memory's any good, 3.3 is working capital. See you then.